Folks, you better get ready. In today's video, we are going to be diving into one of the most unique small cap stocks on the market right now. A stock trading around $8.82 that just went headfirst into the AI space and is doing something major. This small cap stock is becoming an AI landlord, and I think is going to be a massive powerhouse in the space. This company already has billions of contracted revenue on the books and has the backing of Google. And I don't mean Google looked at them and just gave them a little thumbs up. Google actually took a massive stake in them. And when you have a major company that's very central in the economy partnering with a small company, well, that tends to be quite the powerful headwind, right? And so in today's video, we're going to break down everything you need to know about this stock, and I'm going to make the case for it. And then we're going to go on to our sponsored segment on Medicus Pharma Limited, MDCX, on the NASDAQ, a biotech/life sciences company focused on commercializing novel treatment for non-melanoma skin cancer, especially basal cell carcinoma, using a patented technology. We'll present why you may want to put it on your radar and look into it as soon as possible. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Timestamps down below. Let's get right to work. Okay, so no beating around the bush. Today we're talking about TeraWulf, ticker symbol WULF. Folks, Wolf has long been known as a Bitcoin miner, but they are now aggressively expanding their strategy to include what you could call AI landlording. Now, folks, we talked about this the other day with Mara, and we've talked about this in terms of other miners, but there's a lot of miners right now that have done very, very well in the Bitcoin mining space, but they're looking to expand and diversify their massive infrastructure capacity to also include AI, allowing them to benefit from Bitcoin mining, but also AI compute, which is great because long term, if Bitcoin continues to run, which we believe it will, Wolf is going to win. And at the same time, as AI demand expands, Wolf is also going to win. You can see that their HPC capacity, their high performance computing capacity, is growing, and their leases are already multi-billion-dollar contracts. So with this company, you're getting dual exposure to the massive cryptocurrency market, but also to, of course, the AI market. And the contracts are so large that it's totally re-rating the business from a speculative miner to potentially a massive infrastructure play in the massively booming AI space. And with big backing, the revenue model and the projections for this company are getting more and more de-risked, and the cost of capital is vanishing very, very substantially. And I think that markets haven't really caught up to this yet. With Wolf, you basically have a company that's giving you exposure to the massively booming Bitcoin industry, but more importantly, the AI infrastructure space. One that everybody and their mother is rushing to get into, but takes years to scale into, where TeraWulf has already scaled into it because, quite frankly, they were doing Bitcoin mining. So now a lot of that infrastructure can be pivoted over to AI cloud computing. So remember, folks, AI investment is absolutely skyrocketing right now, and the industry size is expected to be one of the biggest in history. But what a lot of folks don't talk about is all the processing power needed behind that. And that's the demand that Wolf is trying to tap into here. And it looks like they're going to be very, very successful. See, they've now become a high performance computing landlord, building and leasing out AI optimized data centers. That means they don't just buy in Bitcoin anymore. They rent out AI server space to clients who need serious horsepower. And guess who just moved in on this? Google-backed FluidStack. That's right, Google didn't just nod at Wolf. They didn't give a little naughty McNaughty. No, they now own a stake effectively in this company and are backstopping $1.8 billion in lease obligations, which is a very, very big deal. Google has pledged to support over $1.8 billion of FluidStack's 10-year lease at Wolf's Lake Mariner site. And to align interest, they've taken an 8% equity stake in Wolf, pledged to lenders for the construction of this AI data center. So let me say this again, one of the largest, most central tech companies in the world is literally investing billions of dollars into Wolf's infrastructure build out, and in doing so, giving it their seal of approval. When Google signs on the dotted line and commits billions, that's not speculation, that's conviction, and maybe even a little desperation, because Google has to compete with the many other mega tech players, so they're sending out billions upon billions to do that. Now, Wolf's business model here is simple but very powerful. Build it, power it, lease it. They're leasing over 200 megawatts of capacity to FluidStack at their Lake Mariner site through 2036, worth roughly $3.7 billion in contracted revenue, with another possible $5 billion if lease extensions are exercised. Their site is expected to deliver a whopping $315 million per year in net operating income, representing an 85% net operating income margin. That's incredibly high margin, recurring revenue locked in for a decade. So again, with this stock, it's still being valued as a Bitcoin miner, which quite frankly has been undervalued in this current market environment. However, with this company, you're no longer just looking at a Bitcoin miner, you're looking at a digital landlord collecting rent checks from AI tenants. Now, FluidStack isn't some fly-by-night startup. They're a premier AI cloud platform powering companies like Meta, Nvidia, Poolside, Character.ai, Moon Valley, Samsung, and more. Founded at Oxford University, they're building a 1 gigawatt AI supercomputer in France, and they've partnered with Nvidia, Dell, and Macquarie. That is the caliber of client that WULF is serving right now. And let's talk infrastructure. So look, WULF has 1,150 megawatts of total data center capacity across 2 sites, Lake Mariner and Cayuga. 800 to 850 megawatts of that capacity is still available for new tenants, which means a lot more revenue potentially coming in. You have their Core 42 already leasing 72.5 megawatts. You have FluidStack leasing 250 megawatts. They're planning to deploy 150 to 200 megawatts per year over the next several years, which means, again, opportunities for this company to report more and more revenue. But here's the kicker. So WULF uses nuclear and hydroelectric power, which is not only dirt cheap, around 5 cents per kilowatt, but also 90% zero carbon. Super environmentally friendly and very cost effective. Things that are very important to be able to survive in different types of administrations and different regulatory environments state by state. And quite frankly, I expect both segments to do very well. But why I'm really excited about this stock is because of the trend of American protectionism, right? Bringing everything back on shore. WULF's facilities are in New York, not offshore, and that matters quite a lot. Amid rising scrutiny of foreign data centers and national security concerns, US-based compute infrastructure is becoming a very premium asset. Lake Mariner is also in a zero carbon grid region with sub 2 ms latency to Toronto, NYC, and Boston, making it perfect for real-time AI inference. But despite all of this value add, WULF is still trading a very speculative tiny BS penny stock. There's this level right now where you have a lot of companies in the small cap space that they think, okay, wait a second, if I just simply put AI in my name, my stock's going to do a big rally-ralito. So a lot of people in Wall Street are thinking, okay, I'm not going to buy any of those because it's all hype. They're not really doing anything with AI. It's just bogus BS trying to get people to buy, right? So I think a lot of people are looking at WULF and they're looking at this new AI pivot and they're thinking the same thing. However, the infrastructure needed for Bitcoin mining and the experience and technology and team, well, that's actually quite the easy pivot into AI compute. And I think that once institutions catch on, you're going to see stocks like WULF really start getting a lot of capital. Now, I don't know when that's going to be, but look, at the end of the day, you have to look at the long-term bigger picture of this. There's a lot of other players out there, but with Google backing it, you have not just the markets knowing that Google's backing this, but also you know that Google's team went in and analyzed everything and they decided, okay, it's worth spending $1.8 billion and such. Okay, now it's time for the risks. So like every stock, WULF is not risk-free. This is still an early stage company with $410 million in somewhat net debt, ramping up CapEx and dependent on execution. They're still exposed as well to crypto volatility, and this AI lease model is new territory for them. So those are risks to consider. But the high margin, long duration contracts they have, the dirt cheap power, the Google validation. Well, that's why I think that while this is a high risk stock, it also has high reward potential if you are patient. Now, over the next 12 to 18 months, WULF is aiming to deliver over 200 megawatts to FluidStack, record revenue from multiple hyperscale tenants, ramp up capacity at their Cayuga with another 400 megawatt site, potentially expand the FluidStack contract even further, and position themselves as the go-to AI compute landlord with US infrastructure. So in my view, you're looking at this company that's trading at very low valuations for the endless opportunity down the road, and you're thinking, okay, well, this is an interesting play. Now, if you are in the Discord we just sent out, call options on WULF stock with a specific expiration date and a specific strike price to specifically target an upside potential in this stock. If you're a member, make sure to check that out. If you're not yet, we have the link down below. Okay, now it's time for our sponsored segment. Today's sponsorship segment is on Medicus Pharma, MDCX on the NASDAQ, which is a biotech/life sciences company that's aiming to do something bold in the world of oncology. At its core, Medicus is built around a clear mission: accelerate the clinical development and commercialization of novel de-risk therapeutic assets. They essentially find high potential treatments, ones already showing signs of effectiveness, and push them towards the finish line. Their lead asset is SkinJect, a needle-free, non-invasive pharmaceutical delivery patch designed to treat basal cell carcinoma, the most common form of skin cancer in the US of A, affecting more than 5 million Americans annually. But SkinJect isn't just a nice idea, it's a full-blown platform opportunity, and MDCX is already knee-deep in an FDA-reviewed Phase 2 trial. The company holds exclusive worldwide rights to this tech through agreements with Carnegie Mellon and the University of Pittsburgh, and they're building a case for SkinJect as the next big alternative to painful scarring surgeries like Mohs. So Charlie, what are a few reasons why Medicus deserves a closer look? Well, number one, it's a game changer in skin cancer treatment. Skin cancer is a massive and growing problem. BCC is projected to exceed $15 billion annually in market value by 2030, with treatment volumes growing at 4% per year. And Medicus is bringing forward a simple office-based solution, a dissolvable microneedle patch loaded with doxorubicin. It's designed to be applied once a week for 3 weeks, painless, localized, and quick. You got to compare that with surgeries that carry significant risks of infection, scarring, and significant healing time. Number 2, strong clinical momentum backed by real-world data. So MDCX isn't just in the idea stage, they're actually executing. After completing a phase 1 trial in 2021, Medicus submitted a phase 2 IND to the FDA in early 2024 and began recruiting patients across 9 U.S. sites in August 2024. That trial has since expanded to include up to 90 patients, with more than 50% already enrolled. In Q1 of 2025, interim data revealed over 60% complete clinical clearance, a result that generated serious validation. And more progress is around the corner. A Type C meeting with the FDA is scheduled for Q4 2025, which will take place following the interim readout to inform next steps with regulators. This isn't a pipeline on pause, it's a clinical program in motion with eyes on a pivotal trial in 2026 and a potential FDA submission by 2027. Number 3, real competitive advantages. So SkinJect's microneedle delivery approach is doing more than replacing scalpels. It's building a new standard. The cost is estimated at about $1,000 for a full treatment versus up to $15,000 for surgery. In terms of time to treatment, same day use is possible, while most surgery can involve a 2 to 8 month wait time. User experience is high patient and physician acceptance, minimal irritation, and no scarring compared to typical lumpy post-surgical results. On the treatment matrix shown in the company's own clinical comparisons, SkinJect scores high on efficacy, convenience, safety, and price, all the categories that drive market adoption. Number 4, IP protection and platform potential. Medicus holds exclusive worldwide rights to the SkinJect technology, including patents that run through 2035. Those cover both the microneedle composition and its transdermal pharmaceutical delivery mechanism. But this isn't just about BCC. The company is already preparing follow-on INDs for conditions like acentic keratosis, squamous cell carcinoma in situ, and even equine squamous cell carcinoma. In other words, this is a pharmaceutical delivery platform with multiple paths to growth, not just a one-trick pony. Number 5, and very importantly, experienced leadership with a playbook for execution. The leadership team is packed with medical, scientific, and public company experience. CEO Dr. Raza Bokhari leads a seasoned team with backgrounds in oncology, capital markets, pharma development, and biotech operations. And it's not just internal confidence, Medicus is gaining outside recognition too. The company ranked number 7 in 360i Research's strategic positioning matrix among major players in the global BCC treatment space, competing in the same field as pharma giants like Regeneron, Bosch, and Roche. So anyways, folks, here you have a company showing strong clinical progress, IP-backed tech, and a truly differentiated approach in a multi-billion-dollar market. Medicus Pharma MDCX stands out as one of the more compelling small-cap pharma stories on the board right now, and it's one that you should be putting on your radar as soon as possible. And of course, every small cap is with risk, so you got to make sure that you're doing your own due diligence. And anyways, that caps off today's video. Have a great rest of your day. We'll see you in the next one.